Hey everybody, welcome back to my channel. In today's video I'm going to give you a little bit of insight into technical analysis for commodities, and you can use a mathematical trick to sort of predict the bull market runs in commodities and their potential peak prices by using a calculating technique called the rule of 7. Okay, so let me go over what the rule of 7 is right quick. The rule of 7 is that when you take a commodity and start acknowledging that it is in a bull market, when you analyze the first leg of that commodity's rise in price, so let me give you an example here. I'll use copper right here. Copper's first leg up, meaning its first increase in price, and I usually define a leg as when it increases over the previous ceiling peak that confirms it's in a bull market run. When it lifts over that and reaches its first peak above its previous peak and it's confirmed to be in a bull market, you can use that to calculate, you can use the rule of 7 to calculate just how far its bull market run will go. And to give you the shortcut, it is the difference between its low and its first peak times 7. Okay? So in this case, the difference between the low of copper's price, which is $2.17, and its first peak of $2.90 is 73 cents. So if you take 73 cents and multiply it by 7, then according to the rule of 7, you add that to the low price of copper, and that's going to give you copper's potential peak when it does peak in the bull market. And in that case, then it would be pointing to a target price of about $7.30 from a peak of $2.17. And you can do this with commodities. You can even do this with stocks and bonds. The trend tends to hold true because it follows a Fibonacci sequence. But if you know anything about using trend analysis, you always know that there's room for error. When a bull market breaks down, or when external events like COVID or 2008 disrupt the natural market cycles, you know, those kinds of shocks, whether they be demand shocks, supply shocks, or something else, acts of God, then no amount of math, no amount of trend analysis is going to save you during that time. So, you know, keeping that in mind, there's always room for error. And even using this mathematical trend, it can be wrong. And as a matter of fact, what it does is that it establishes 4 targets in its calculatory path. And with each target surpassed, the next target becomes statistically more difficult to realize, okay? So there's a greater tendency for the forecast to be wrong with each target met. That being said, the rule of 7 does tend to be pretty accurate. So the first target price will be 7/4 of that difference between the first peak and the first low plus the low, okay? And then the second target will be 7/3 of that price. And then the third target will be 7/2, and then the fourth target will finally be 7 times that difference in price plus the low. And it typically happens that the time period between the leg and the low tends to be the time for the first target. So if it took 133 days, this is what aluminum prices are showing here, to get from the low to the first peak, then it'll probably take about 133 days to get to the first target, and then it would take 266 days to get to the second target from that leg, and then so on and so forth. So these time periods are taken into account from the initial low. So it's 2 time periods. So it would be 266 days from the low, not 133 from the peak, but they add up to be the same. And then this would be 3 time periods. Then the third target would be 5 time periods, and then last target would be the 4th time periods. But enough about that. Let me give you and demonstrate you some real life examples of what's going on in the commodity prices today, so you can judge for yourself whether this is something to go by or something to discard. That, of course, is your choice. As for me, I do take into account trend analysis, but I don't always accept it as gospel law. That being said, this mathematical tool of forecasting tends to be eerily accurate, and I have charted it out and have documented many cases where it tends to be spot on. So let's start with copper, okay? So according to copper, the leg was from 217 to 290. The difference was 73 cents, so it gives you a price target of 728 at the end after you achieve all four targets, okay? So let's go into motion here and see where we are in this copper trend, okay? So it tells us that the first target should be about $3.45, and it should be achieved about October 20th, or October 26th of 2020, okay? So when we look back at copper's price and we go up to through the dates here, we should be looking for that $3.45. And sure enough, it was realized. Now, it was realized a little late here, okay? So it was realized a little bit after October. It was realized in November, so it's about a month late. So what I did is in column D, did a modified target date. I sort of just took the difference and ran with it and sort of projected it out and says, okay, well, because this was off, that means it pushed it back by, say, a month and a half for the next target, and then roll it from there. Now, that being said, what was your second target? Well, it was going to be $3.87. So when we go back to copper's price and we look up and we look for $3.87, well, lo and behold, we hit right on the dot at February 15th, $4.07, which that goes back to the original target date. That was realized. So second target was achieved. Now we go to the third target. It tells us that we should be hitting about $4.73, and that will be realized at some time in September of 2021, okay? However, we already achieved that $4.73 right here on May 3rd, so we're ahead of schedule. We're actually ahead by almost 5 months of schedule here. We saw this sharp increase in copper prices, so that sort of pushed up the timetable of when we could potentially hit this fourth target. And what's it pointing to? Well, it's pointing to this fourth target. It's pointing to copper prices spiking yet again, and it's going to spike up to $7.28. Now, that being said, will this fourth target be reached? I don't know, okay? It just tends to be that the mathematical calculation of the rule of 7 tends to be true, but it's not always the case. And again, with each target, there's a greater probability that the target will miss, okay? But either way, it's signaling that this bull market is not over yet. We're signaling another strong push up in price. So we'll see if that plays out. But if so, that's going to point that the commodity rise in prices is just beginning, and we haven't even seen the half of it yet. Now let's go to aluminum and do the exact same thing. Give you another case example here, okay? So aluminum bottomed out in April 6th of 2020 at about 1465.65. It then goes up to its leg above its first initial high here of 17, let me see, where is it? It's about 1792.30, right? That's it, 1792.30, not 1793.50 is what I've got. So it's just, so I've got a couple variations here, okay? And the date that was reached was on 8/17. There it is. So there you go. So it reached us up to 1793.50 on 8/17, and that took it a little bit over 4 months, almost 4.5 months to get to that point. Okay, so that tells us that the price target for aluminum is actually going to be 3,760. So we're going through a huge bull market in aluminum. So let's see how this plays out. Well, its first price target prediction is that you're going to reach about $2,040 on 12/28/2020. And sure enough, we actually went ahead of target, and at about 11/30/2020, we actually surpassed that, and we reached a price of about, let's see here, it should be 2,045. Okay, so that price target was achieved, and it was actually achieved ahead of schedule. So my modified target date kicked in and said that by the end of March we should be hitting a target price of about 22.30. And sure enough, right before the end of March, we surpassed that and hit a price of $22.65.50. So that was achieved and almost right on schedule of the modified date. So the next date is supposed to kick in on 11/5/2021, and we were supposed to reach a target price of $26.13. Yet on August 2nd, we already reached that $26.13, and we're ahead of schedule here. So now that target price is achieved. So what's it saying for the fourth target? Well, it's predicting that we're going to top off at $37.60, $37.61, and the modified target date has it about May 18th of 2022. The original target has it in March of 2023. So again, this is another evidence that the bull market in commodities is also increasing here. Now when we go to crude oil, we go to Brent crude, we can see a similar development that goes on. And so let me pull up the Brent crude prices right quick and let you see the chart here. Let's see if I can't pull it up right quick. Let's see here. I think this is going to give it to me. This was a sharp dip that was going on. Oh, let's see here. Okay, so I went from here about 10/20, 2020. Okay, well, I'll go off of this data that I have. So from what I've collected on Brent crude here, this one seems to be showing the start date at 10/29/2020 and a bottoming out of 35.79. So I kind of excluded here from April 2020 its original ultimate bottoming out, and that was because of the COVID situation. So I sort of took it from this dip right here at the end of October. Okay, so I've got it at the end of October dipping down to about 35.79. And then on November 24th, the first leg was achieved, and it rose up to 45.71, which was a 26-day time period. Okay, so that led me to a price target ultimately of $105.23. So your first target would be 53.15, and we should be seeing that toward the end of 2020. And sure enough, right after 2020, in January of 2021, we achieved past that target of 53.15. I have it recorded here that we achieved it on 1/11/2021. So that being said, we were a little bit behind, so my modified target date kicked in and said on February 17th, we should hit a target price of $58.94. So sure enough, we go to February. And when we go to February, in mid-February, actually in early February, we achieved that target. So we're right on the dot. So 2/11 on February 11th, we surpassed that target. So the third target kicked in. Okay, and it said that on about May 2nd, we're going to hit $70.06. Well, we didn't hit it on May 2nd, but we did hit it in June. So in early June, we sure enough surpassed that $70.06. So that means we're looking for the $105.23, and according to this modified target date, it looks like we're going to hit it probably about 10/22. So, that's another thing that remains to be seen. So ultimately speaking, we're looking at higher aluminum prices, higher copper prices, higher Brent crude prices. Now, interestingly enough, crude oil prices have a strong correlation with the PPI for commodities here. So I ran a regression analysis comparing crude oil with PPI inflation, and then took a projection out for PPI inflation using my CPI and PPI projection charts that I've shown you. I'll put a link in the vid about what I've done to calculate those inflation numbers. But interestingly enough, there's a strong correlation between the PPI of commodities, the producer price index of commodities, and oil prices translating into gas prices. Okay, they're very, very accurate within each other. This one was a little off on April 30th of 2011, but it's telling us that if crude reaches that $105.23 by the end of October, then we are looking at a gas price of around $3.72. So congratulations. We're going to be back to $4 of gasoline. Thank you very much. Thank you, President Biden. # Jerome Powell rules. So why am I giving you all of this? Well, I'm giving you all of this for a couple of reasons. One is just, it's interesting stuff to go over. Two is that rising commodity prices in oil, copper and aluminum, those metals, seems to be pointing that the producer price index is going to continue to go up just sheer by the trend analysis using the rule of 7 calculation. That gives you a little bit more supporting numbers, supporting basis that we haven't seen the end of this inflation run yet. As a matter of fact, we're about maybe halfway through it before the producer price index finally decides to peak out, and that means inflation still got room to go, which is going to push up the CPI, which is also going to push up gold. Now, the interesting thing here is that you can apply this to precious metals as well, and indeed I have, okay? So, back in the 1970s, I did the exact same thing that I did for the commodities and did the rule of 7 calculation. Now, you can do this during your own spare time, but you can see the results for yourself, how the numbers were pretty much achieved. Now, sometimes the date that they were achieved would be off. Sometimes it would be pushed off by 6 months to a year, but the calculation was nevertheless the same. It confirmed the bull market and confirmed the trend. And you can see this again and again and again. So, just to give you an example here, like if we were to take the gold price, when gold started to peak at $850, right? And we were to start to take a look at the last trend in gold's price when it was flatlining in the late 1970s after its last bull market, and we were to use that leg up and do the rule of 7, it would tell you that gold's price would peak at about $750.20. Well, gold, sure enough, would peak at $850 on January 21st, 1980, whereas using my little calculation and modifying it, it would say, well, we weren't going to hit the peak of $750 till May 30th. Nevertheless, it was able to predict that gold was going to increase from $250 to $750 within, roughly speaking, of about a year. Okay, that's not too shabby that it's able to predict those kinds of bull market runs just by simple mathematical calculation. The theory behind it is that that run up in the first bull market leg is going to continue on with the same investors and the same momentum hiking it up, and it just tends to be that the price peak is around 7 times the initial difference between the first leg peak and that initial low. And you can see it do it time and time again. Like here, from gold of 2005 to 2010, I did the first leg up in 2005, and I got gold sitting there telling me that I got my rule of 7 calculation telling me that gold was going to top off at about 1245 in 2008. Okay, now that granted, that didn't happen because the 2008 crisis sort of pushed everything back. But then what happened? Well, gold did realize its price. It realized it about a year and a half later, but it still realized the price. So even after my modified target date pushing everything back because of the 2008 crisis, it tended to push everything back by about a year or so, maybe a year and a half. Nevertheless, the calculation proved true. It did confirm it. And the difference is that the 2008 crisis proved to be bullish for gold. It did not turn the bull market into a bear market. Why? Because the economy was becoming unstable. That was going to cause a lifting in price combined with monetary policy that was trying to reflate the asset bubbles that burst in 2008. Now, had the Fed done nothing and decided to let those bubbles burst and the bankruptcies to materialize, we never would have seen this gold price realize itself. But because of Fed monetary policy, it still fulfilled this calculation. Okay, and here if you decided to take the bull run of gold in late 2008, 2009, you would get a gold calculation of 1470 about, and sure enough, we did realize that in 2011 of 1470. Okay, so again, it was about 10 months early after you've taken in the modified target dates, but this rule of 7 tends to play out. Now, one of the interesting things here is that when you take into account gold's 2018 to 2021, the COVID situation disrupted this rule of 7, okay? So this was sort of like a breakdown here. Here we had a prophecy, or not a prophecy, but a calculation that due to the bull market run in 2018 of gold, we were going to have gold top off at 2100, and it was going to top off about September of 2020, right? Just because of the run up in gold. But what happened? Well, we had the COVID situation, we had shutdowns. Now, some of that proved to be bullish for gold, and it is bullish for gold now, but the initial drop and the plunge of asset prices have pushed off this gold price. I do think that ultimately it will become fulfilled, but whether that happens or not remains to be seen. Interestingly enough, we did get close to that peak price. We reached a peak price of $2,048, which was about $50 off of that grand total peak, and it happened on August 5th, 2020. So that is interesting to know. But let's say that, that would caused a miss, and we were just going to look at gold's price today, okay? So we were going to take a look and say, well, all right, well, what's going on with gold now, post the pandemic? Well, on March 30th, 2021, I'm recording here that gold has reached its post-pandemic, after it spiked up here in August, low here of about 1683.95, okay? And then I confirm up here in the leg that gold reached a peak of 1902.75 in June 2nd, 2021. So in the space of about 2 months, gold appreciated about $220. So what's this telling us? Well, this is forecasting that gold is to go into a huge bull market, okay? It's supposed to reach $3,200.15 or $3,216, sorry, and 55 cents. There you go, 32.15.55. Man, my tongue got twisted on here. By August of 2022, so basically roughly in a year. However, it said that, well, the first target will be achieved, which was for gold to push over $2,000, $2,066 on August 5th, 2021. And yet we're nowhere near that, okay? So, as of a few days ago, as of about 6 days ago, gold was at 1812, and now gold has done a historic plunge. So, what gives? Has this rule of 7 been wrong on this calculation for gold? Well, yeah, maybe. Or, like, it has done in times past, it may just be pushing it off. We may not realize this gold target in August of 2021. Maybe it's going to be pushed back a few months, okay? So maybe it's going to be pushed back 2 or 3 months before we actually get up to that back up to that price. But if we do start seeing the price confirmation signals hitting, so if gold starts to get out of its slump, and I think the reason why gold and silver and precious metals are in a slump is because the debt ceiling is about to be reached, as well as with the rising pandemic. So again, we're in an extraneous situation, an extra economic situation, so to say, where outside forces, in this case a pandemic, is disrupting the normal flow of prices. And in this case, it could be disrupting the shipment flows of gold and silver, which affects the futures contract prices for gold and silver, which may be pushing down its price, combined with the fact that the debt ceiling has been reached, so no new debt's being levied out right now, so bonds are the safe go-to. So there's some interesting events that are going on with gold today that may actually cause us to miss this sort of target calculation. And in that case, then, the rule of 7 may not necessarily apply in gold. However, with that being said, it has certainly applied in the commodities. So it's definitely been achieved for the first 3 targets for aluminum, for copper, and for Brent crude, and all of this is post-pandemic, okay? So all of this is either during that pandemic or right after that pandemic. So what's it should be saying for gold? Well, that being said, it should be telling us that, yes, this should hold true. Whether it will or not will be seen, but either way, it just is an interesting calculation, okay? Now, just to give you, one more buffering piece, I did a calculation based off silver, based off of silver's bull market run in 2018 and 2019, and you can see here how it scarily predicted silver's rise in price. And apparently the pandemic didn't really affect it all that much. I mean, look at this. It predicted that silver would top off at $28.74 on July 30th, 2020, and silver did that on September 1st, 2020. So it was off by about a month. That's scarily accurate that you could go back in time for about a year and a half or so and take a look at what the trend is and just do a simple mathematical equation that you can do on your calculator and chart out what the rise in price and peak would be for commodities, precious metals. You can do this with stocks as well, especially with major stock indices. So very interesting stuff that I'm showing you here. I find this absolutely fascinating. So anyway, take this for what it's worth. You know, do your own research into the rule of 7 to figure out its limitations. If you find out anything, or if you know anything, just let me know. I found this very interesting, nevertheless, because it just tends to hold true. Guys, if you like this video, make sure you click that like button, hit that subscribe button, so that way you can be subscribed to my channel, and anytime I upload a new video, it'll pop up into your feed. And also make sure you hit that notification bell if you really like my content and you just can't wait to see the next video. That way, you know, you'll be notified as soon as I upload a new one. Now, I can tell you that this week is going to be a busy week for me. Tomorrow, I'm going to be uploading my feedback on the CPI reports. I'm definitely going to upload a video on Thursday about the producer price index report. So Wednesday, Thursday, I'm going to be hitting those videos back to back and go over that data of what's to come. And, you know, I give you kind of an analysis on where I think we stand during this commodities bull market and what that means for inflation using my inflation projection charts. Again, guys, I thank you for watching this video, and I'll talk to you next time.